Welcome to the Deep Dive, where we sift through mountains of information so you don't have to. Today, we're exploring a world that's really shifting beneath our feet. Global military spending has hit an unprecedented $2.7 trillion. That's the steepest rise since the Cold War, really quite staggering.
It is. And at the same time, you've got this explosion in the digital economy just expanding relentlessly. And commercial aerospace, it's soaring again after, the pandemic slump.
Exactly. So, in this really dynamic landscape, you have to ask, who are the key players actually shaping these massive trends? Who sits at the intersection of all this? And that's why our mission today is to unpack, well, a pretty extensive stack of investment analysis, research reports, and data on one company positioned right at the heart of these shifts, Thales SA.
Thales, yeah.
We're going to try and extract the crucial insights, connect the dots between its pretty diverse businesses, the market dynamics it's navigating, and its, frankly, impressive financial performance. Our goal here is for you, the listener, to walk away from this deep dive really well informed about a major global technology player.
Absolutely. And Thales SA isn't, just any company. It's a global technology leader, and it's very strategically positioned. It sits right at the intersection of these high-growth markets that are also, crucially, very hard to get into.
High barriers to entry.
Exactly. We're
Yeah.
talking defense and security, aerospace, and digital identity and security, or DIS. And something really critical to understand about them right now is that they've recently gone through a significant strategic realignment. They've really sharpened their focus onto these core high-tech areas.
Okay, so a more focused Thales. And what makes this deep dive so relevant right now is how skillfully Thales seems to be leveraging some incredibly powerful sort of long-term market forces, these secular tailwinds.
Yeah, they're riding some big waves.
You've got this global defense spending supercycle, fueled by all the geopolitical tension we see. Then there's the robust recovery in commercial flights, aerospace bouncing back, and of course the structural, relentless expansion of the digital economy. So this isn't just us profiling a company, it's really a look at how these massive global forces are shaping a major industrial player and how that player is adapting and, frankly, capitalizing on them.
It's a fascinating case study, really. So to elaborate a bit more on Thales' unique position, it's important you understand they aren't just, say, a defense contractor or just an aerospace supplier. They're not easily pigeonholed.
Right.
They've carved out this distinctive niche as a leader in critical technologies. Often these technologies are dual use, meaning they have both military and civilian applications, and these technologies are relevant across multiple strategic sectors.
So they build the foundational tech bricks, as it were.
That's a good way to put it, yeah. Foundational technological bricks that get applied in incredibly diverse, high-impact ways, from radars to satellites to cybersecurity.
That dual-use angle is really interesting, and you mentioned that strategic portfolio realignment earlier. Can you unpack that a bit more for us? What exactly did they sell off? What did they buy? And what was the thinking behind it all?
Sure. It was a very deliberate process, really aimed at streamlining the business and focusing resources. So on one side, they divested their ground transportation systems business. They sold it to Hitachi Rail.
Okay, the train signaling stuff.
Yeah, that kind of thing. It was generally seen as a lower margin, more capital-intensive area. So exiting that freed up capital and management attention.
Makes sense. And the acquisitions.
On the other hand, they made some significant acquisitions to bolster their core high-tech areas. The big ones were Imperva, which is a major player in cybersecurity.
Right, application and data security.
Exactly. And also Cobham Aerocoms, which strengthens their hand in avionics, specifically cockpit communication systems. So these moves really underscore that sharpened focus on defense, aerospace, and digital identity and security.
That kind of deliberate focus usually pays off. Let's maybe dive into a quick snapshot of their recent results. Fiscal year 2024, just to set the scene, because they did hit some pretty impressive numbers.
They certainly did.
Their sales actually broke through the $20 billion mark. That's a big milestone. And it was driven by strong organic growth, 8.3%, which I believe even beat market expectations.
Yeah, it did. It highlights a pretty robust commercial environment for them right now, and good execution, too. But maybe even more important than the sales number, especially for you, the listener, thinking about stability and predictability, is their record order backlog.
Ah, yes, the backlog. How big did that get?
It reached nearly 51 billion by the end of 2024. 51 billion euros.
Wow.
What that means is they have multiple years of revenue already locked in, essentially, particularly in their biggest segment, defense and security. Think of it like having confirmed bookings stretching years into the future.
Right, it smooths things out, reduces the quarter-to-quarter volatility.
Precisely. It gives them immense revenue visibility, which is a huge asset in, well, let's face it, an unpredictable world. It's a cornerstone of their stability.
Okay, so strong sales, massive backlog. What about profitability?
Also on a good trajectory, their adjusted EBIT margin, that's earnings before interest and taxes, adjusted for one-offs, reached 11.8% in 2024. That shows consistent improvement over recent years.
Okay, 11.8%. And I remember reading something quite remarkable about their cash generation.
Ah, yes, that's really the standout characteristic. Their exceptional cash generation. Thales has managed 5 consecutive years where their free operating cash flow conversion was over 100%.
5 years over 100%. That's unusual, isn't it?
It's very strong. So what does that actually mean? A free operating cash flow, or FOCF, conversion ratio over 100%? Well, for you, it's a real testament to incredibly strong working capital management.
Managing their inventories, receivables.
Exactly, and often it reflects favorable contract terms too, like getting significant upfront payments, especially on big defense deals. Essentially, they're generating more hard cash than their reported net income on the accounting books.
Which is significantly above the industry average.
Oh, definitely. This metric speaks volumes about the quality of their earnings. It's not just paper profit. It shows they can effectively manage the cash cycle of these often very long-term, complex projects. It's a hallmark of financial discipline.
Okay, impressive stuff. So looking ahead, what are the dominant themes shaping Thales' future? What are the big drivers and maybe the challenges?
Well, the primary driver, I mean, you can't ignore it, is that unprecedented surge in global military spending we talked about. Geopolitical tensions are directly fueling growth in Thales' largest and most profitable segment, defense and security. That's number one.
Okay.
Beyond that, you've got stable demand from the sustained recovery in global air travel. That's a nice tailwind for their avionics business. Then there's a major strategic opportunity for them to leverage their expanded digital identity and security, the DIS portfolio, especially with Imperva now integrated, in that fast-growing cybersecurity market. That's the growth engine.
So defense stability, aerospace recovery, digital growth.
Yeah.
Any clouds on the horizon? Challenges.
The main internal challenge, the one management is very focused on, is the critical task of restoring profitability in their space division. That's been a bit of a drag on overall performance recently. We can get into why later, but turning that around is key.
Okay, we'll definitely circle back to space. So if we pull all this together, what's the overall profile of Thales SA that emerges?
I think you see a really well-managed, technologically advanced industrial company. Crucially, it's incredibly well-aligned with some very strong long-term market trends. That record backlog gives it defensive qualities, a high degree of predictability. It's a solid foundation.
But not without risks, I assume.
No, of course not. For you, the listener, it's important to understand the inherent risks. They're exposed to government budget cycles, which can shift. Executing these huge, complex programs is always challenging. Delays, cost overruns, technical hurdles are always possible.
And the geopolitical landscape itself is volatile.
Absolutely. And given that the market has already priced in a lot of optimism, giving Thales a pretty premium valuation, well, flawless execution of their strategy, especially their ambitious 2028 plan, isn't just important. It's absolutely paramount to justify that current valuation. The pressure is on to deliver. #tag2. Deep dive into Thales' business segments. Okay, let's dig into the different parts of the business. Thales operates a really interesting model. It's diversified, yes, but also highly synergistic.
How so?
Well, its structure allows it to leverage those core technology competencies we talked about across very different markets. This creates a portfolio that's quite resilient. It balances the long-cycle government contracts in defense, which provides stability, with the more cyclical commercial activities in aerospace, and then adds the high-growth potential of the digital markets.
So it's like a layered approach, hedging their bets a bit.
Exactly. It's a clever way to hedge and optimize their exposure to different market cycles and growth drivers.
Okay, let's start with the biggest piece. Defense and security, or DNS. This is really the historical foundation of Thales, right? And still the largest chunk of revenue and profit.
That's right. It's their cornerstone. And a key thing to grasp about their approach here is that it's very technology-centric. They're not usually building the massive platforms themselves, the tanks, the ships, the fighter jets.
They provide the insides.
Yeah.
The brains.
Precisely. They focus heavily on the electronics, the software, the sensors, the systems integration. This positions Thales as a critical technology enabler for the big platform manufacturers and for military end users. They provide the advanced eyes, ears, and nervous system for modern defense capabilities.
Can you give us some specific examples of what they do within DNS?
Sure. It's quite extensive. They develop cutting-edge radar systems, I think the Groundmaster family for air surveillance, very well known, and advanced sonar systems for submarines and surface ships.
Okay, sensors. What else?
They're also deep into mission systems. This includes complex command and control systems, C4I as it's known, command, control, communications, computers, and intelligence. Basically the digital backbone for military operations.
So coordinating everything.
Exactly. This also covers things like sophisticated electronic warfare suites. The Spectre system on the Rafale fighter jet is a prime example, protecting the aircraft from threats. And of course, military-grade avionics for aircraft and helicopters.
Got it. Any other major areas?
Yes, secure communications are huge for them. Tactical radios, satellite communication systems, and absolutely critical cybersecurity solutions specifically hardened for military networks and data. They even participate in missile systems consortia, like Eurosam, contributing key technologies like seekers and electronics for missiles such as the Aster family.
Right, so they're embedded in many different parts of the defense ecosystem.
Deeply embedded. And this DNS segment is, as you'd expect, the primary beneficiary of this current global defense spending upswing. In 2024 alone, it pulled in $14.7 billion in new orders.
$14.7 billion. And you mentioned the book-to-bill earlier.
Yeah, for DNS specifically, the book-to-bill ratio in 2024 was 1.34. So for you listening, that means they were signing new contracts 34% faster than they were recognizing revenue from existing ones.
Which builds that backlog even faster.
Precisely. It's built up a segment-specific order book that now provides over 3 years of revenue visibility, just in DNS. It really highlights the strength of the current demand and Thales' success in capturing these large long-term contracts.
Okay. From the cornerstone of defense, let's pivot to another critical pillar, aerospace. Now, this segment, as I understand it, has two quite distinct parts, avionics and space. Let's tackle avionics first. What's Thales' position there?
In avionics, Thales is a leading global supplier. They provide the onboard electronics, the avionics, for both civil and military aircraft. Their portfolio is really broad.
Like what specifically?
We're talking integrated flight decks, those complex glass cockpits you see, flight management systems that automate navigation and surveillance equipment, electrical power generation and management systems. And a really significant and historically very profitable area for them is in-flight entertainment and connectivity, IFEC.
The seatback screens and the Wi-Fi.
Exactly. Providing those systems that passengers interact with, that's a big business.
And the performance of avionics is obviously tied to the airline industry's health.
Very closely tied, yes. It benefits from two streams. First, new aircraft production that's called line fit, when their systems are installed as the plane is being built by, say, Airbus or Boeing. Second, the maintenance, repair, and upgrade cycle for the existing global fleet, that's the aftermarket.
And the aftermarket has been strong lately.
Extremely strong, especially post-COVID. As air travel recovered, airlines needed to maintain their existing planes and upgrade them. We saw Thales' civil aviation aftermarket activities grow organically by over 30% in 2023. That was a major boost to the segment's performance and profitability, as aftermarket tends to carry higher margins.
Okay, so avionics is benefiting from the travel recovery. Now, what about the other part of aerospace? Space. This is run through a joint venture, right? Thales Alenia Space.
That's correct. Thales Alenia Space is a JV with Leonardo of Italy. This business designs and manufactures satellites and complex space systems.
For what kind of applications?
A whole range. Traditional telecommunications satellites, Earth observation satellites for environmental monitoring or surveillance, navigation systems. They're a key partner in Europe's Galileo constellation, for instance, and even complex scientific exploration missions, building probes and instruments.
But you mentioned earlier that the space business has been facing some challenges recently, headwinds.
Yes, that's true. Our sources point to delays in execution due to supply difficulties, which hit them in 2023. And also, perhaps more structurally, a fall in demand for geostationary communications satellites.
The big traditional telecom satellites. What's driving that fall in demand?
It reflects a pretty significant market shift that's underway. There's a move away from those very large, expensive geostationary satellites towards constellations of smaller, more numerous satellites in low Earth orbit, or LEO, think Starlink or OneWeb.
Right, the mega constellations.
Exactly. This LEO market is also characterized by intense competition, often from newer, more agile players. So Thales Alenia Space has found itself caught a bit in this transition.
So how are they responding? What's the plan to turn it around?
Management has been very clear about this. Their strategic focus for the space business right now is firmly on restoring profitability, rather than just chasing top-line growth or trying to win every LEO contract out there.
So focusing on the bottom line, not just sales.
Precisely. They're concentrating on improving project execution, getting better control over their supply chains, streamlining operations, and really focusing on the higher value applications where they have a strong technological edge, like observation, navigation, government programs, rather than competing purely on price or volume in the more commoditized parts of the changing satellite market. It's about margin recovery first and foremost.
Okay, let's move to the third main pillar, digital identity and security, or DIS. Now, this segment feels like Thales' strategic push into newer, high-growth digital markets, right? And largely built through acquisitions.
That's a very accurate description. It really represents their big move into digital trust and security solutions. It started in a major way with the acquisition of Gemalto back in 2019, which gave them a huge foundation in areas like smart cards, mobile connectivity tech, and digital security.
Gemalto was massive.
It was transformative, and then they significantly scaled up their cybersecurity capabilities with the purchase of Imperva in 2023. So yes, acquisitions have been key to building this DIS segment into a major growth engine for the group. They're really establishing themselves as a core provider of trusted digital solutions in a world that desperately needs them.
So what are the key activities within DIS today? What do they actually offer?
It's quite diverse, reflecting those acquisitions. A big part is their cybersecurity services portfolio. This includes things like data protection, think encryption technologies, key management systems to control access to sensitive data. Then there's application security, significantly boosted by Imperva's web application firewall, WAF, and data security solutions. And also cloud security services, helping organizations secure their move to the cloud.
Okay, cyber is a big piece. What else?
Another major area is biometric and identity solutions. This involves producing highly secure physical documents like passports and national ID cards, which still relies on sophisticated tech. But it also increasingly involves developing biometric verification systems, fingerprint, facial recognition, iris scanning for things like border control, secure access, and online identity proofing.
Very relevant today.
Absolutely. And finally, they still have a significant presence in smart cards and digital payments. This includes the secure EMV chips in the payment cards we all use, and also SIM cards for mobile operators, although that part is more mature and evolving rapidly with things like eSIM technology.
Got it. So how does the business model in DIS compare to, say, defense? It feels quite different.
It is quite distinct, yeah. While defense and security is dominated by very large long-term projects with long sales cycles, DIS generally operates on much shorter sales cycles, think months rather than years. And critically, it has a much higher proportion of recurring revenue, especially from its software and services offerings. Think subscriptions for cybersecurity protection or software licenses.
Which means the revenue recognition is faster.
Exactly. Revenue is recognized much more quickly, often monthly or annually on a subscription basis, or sometimes even per transaction. This means the book-to-bill ratio in DIS structurally tends to hover closer to 1.0, not because demand is weak, but because the backlog converts into revenue much faster than in DNS.
And what are the implications of that for the group overall?
Well, as DIS continues to grow and becomes a larger proportion of Thales' total revenue, which is the strategic goal, it should contribute to a more stable and predictable quarterly revenue pattern for the group. It also has the potential to improve the overall group cash conversion cycle over time because less capital gets tied up for long periods and large projects compared to DNS. It adds a different, faster rhythm to the business mix. #tag revenue mix and geographic exposure.
Okay, so we've looked at the three big segments. DNS, aerospace, with avionics and space and DIS. Pulling it all together, what does this mean for Thales' overall revenue mix and where their business comes from geographically? You mentioned $20.6 billion in total sales for 2024.
That's right, $20.6 billion total. Our sources didn't provide the precise sales breakdown by segment for 2024, but the order intake figures give us a very clear picture of the business's current composition and, importantly, its direction.
Okay, what did the order intake look like?
Defense and security was clearly the largest contributor, pulling in that $14.7 billion in new orders we discussed. Aerospace followed with $6.4 billion in orders. The DIS segment's order intake isn't usually broken out in the same way because of that faster revenue recognition cycle, but its sales growth is a key indicator there.
Got it. And geographically, where is the business concentrated?
Geographically, Thales maintains a remarkably balanced global footprint, which is a real strength. In 2024, the mature markets, primarily Europe, North America, and Australia, remained the largest source of business, accounting for $19.0 billion in order intake.
So it's still heavily reliant on established markets.
They're the foundation, yes. But a really significant growth engine actually came from emerging markets. Orders there surged by 39% organically in 2024, reaching $6.3 billion.
39%. Wow. Where was that growth coming from mainly?
It was particularly strong in the Middle East, which saw an incredible 80% organic increase in orders. There were also significant contributions from Asia. This really highlights what you could call a powerful dual-engine growth model for Thales.
Dual engine.
Yeah, balancing the stability and volume from established, mature markets with the high growth potential coming from these rapidly expanding emerging regions. It gives them both scale and dynamism. #tag strategic rationale of diversification.
This diversification across segments and geographies, it clearly isn't accidental.
Yeah.
What's the core strategic rationale behind maintaining this complex structure?
There are several key reasons, and it's fundamental to their strategy. Firstly, and perhaps most obviously, it provides resilience.
Yeah.
It acts as a natural hedge against market cyclicality.
Oh, so?
Well, the stability of the defense and security business, which is typically funded by long-term government budgets less tied to economic cycles, can often offset downturns in the more economically sensitive commercial aerospace market. We saw this play out very clearly during the initial shock of the COVID-19 pandemic, where DNS held up much better.
Right. That makes sense. What else?
A second really clever aspect is leveraging that dual-use technology concept we touched on earlier. Core technological capabilities, think advanced sensors, cybersecurity know-how, artificial intelligence algorithms, satellite communication tech, are often developed centrally within Thales R&D.
Okay.
Then these core technologies can be adapted and deployed for both military and civil applications across their different segments.
Can you give an example?
Sure. The deep cybersecurity expertise developed within the DIS segment, protecting sensitive data and transactions, is absolutely critical for securing flight control systems in their avionics business and for building robust, secure command and control networks for their DNS customers.
So the tech cross-pollinates.
Exactly. This allows them to effectively amortize their significant R&D investments over a much broader revenue base than a pure-play competitor could. And it fosters innovation, as breakthroughs in one area can potentially benefit others. It's a powerful synergy.
Okay, resilience, technology synergy, anything else?
Finally, this diversified structure gives them broad exposure to different growth drivers. Each of the three main pillars is influenced by distinct, often uncorrelated market forces. DNS is driven primarily by geopolitical risk and security needs. Aerospace is linked to economic growth, globalization, and travel demand. And DIS is propelled by the massive ongoing trend of digitalization and the increasing need for digital trust and security.
So they get to play in multiple growth stories at once.
Precisely. It allows the group to capture growth from multiple diversified secular trends, which provides a powerful strategic advantage for overall stability and robust long-term expansion. It makes them less reliant on any single market dynamic.
Okay, let's shift focus now to those powerful industry tailwinds we keep mentioning. These are the big macro-level forces that are really propelling Thales forward and creating significant opportunities for them.
Yeah, understanding these is crucial to understanding their current performance and future potential. #tag global defense spending supercycle.
First up, and it's impossible to overstate its significance, is the global defense spending supercycle. I mean, this is a truly seismic shift we're witnessing. World military spending hit that staggering $2.718 trillion in 2024. That's a 9.4% real increase from 2023, adjusted for inflation.
9.4% real increase. That's the steepest year-on-year rise since at least the end of the Cold War. It's genuinely historic.
And it's not just a blip, right? The global military burden, which is spending as a share of global GDP, rose to 2.5%. And this surge isn't isolated to one region.
Not at all. That's a key point. It's a worldwide phenomenon. Spending increased across all 5 major geographical regions for the second year running. The primary drivers are pretty clear. The ongoing high-intensity war in Ukraine is a major factor, particularly in Europe, but also heightened geopolitical tensions simmering in the Middle East and East Asia.
So for you, the listener, the big question becomes, how long will this cycle last? And how intense will it remain? And what does that really mean for companies like Thales that are right in the thick of it?
Exactly. Those are the multi-billion-dollar questions.
Looking at the regional hotspots, Europe is clearly the epicenter of this boom right now. Military spending there jumped 17% to $693 billion in 2024.
17% is huge for Europe.
And NATO members collectively spent $1.5 trillion. That's 55% of the entire global total. And here's a critical point. More and more European NATO members are not just meeting that 2% in GDP spending target. Many are significantly exceeding it.
Right, like Poland.
Poland is a prime example, planning to reach potentially 4.7% of GDP on defense in 2025. That really signals a commitment to a sustained, multi-year investment cycle as nations across Europe recapitalize their armed forces and bolster their defense capabilities after decades of, well, relative underinvestment in some cases.
It's a fundamental reset.
Meanwhile, the United States obviously remains the world's largest spender. Their budget rose 5.7% to nearly $1 trillion, $997 billion in 2024. That's 37% of the global total. Their focus seems squarely on modernizing capabilities, maintaining that technological edge.
Yes, high-end modernization is key for the U.S.
And we're also seeing significant increases elsewhere. Asia-Pacific, the Middle East, Japan's spending rose 21% year-on-year, its largest annual increase since 1952. And Israel's spending surged 65% in response to the conflict in Gaza. It's truly global.
But here's a really key point for Thales' positioning. It's not just the amount of money being spent, it's the nature of that spending that's crucial. The emphasis has fundamentally shifted. We're moving away from the kind of equipment primarily needed for counterinsurgency operations, which dominated the post-9/11 era, towards the advanced technological capabilities required for potential high-intensity peer-level conflict.
Right, state-on-state conflict readiness.
Exactly. Modern warfare, or preparedness for it, places an enormous premium on things like sophisticated electronic warfare systems, secure and resilient communications, multi-domain command and control networks that link air, land, sea, space, and cyber assets, and advanced sensor grids, radars, sonars, electro-optics.
And that plays right into Thales' strengths.
Perfectly. This is precisely where Thales has deep technological expertise and established market leadership. This trend positions them as a key enabler of military modernization worldwide. They capture significant value from the major platform procurement programs, new jets, new ships, new vehicles, by providing the critical high-tech systems embedded within them without necessarily having to build the entire platform themselves. #TagCheck commercial aerospace recovery and outlook.
Okay, let's switch gears from defense to the second major tailwind, the commercial aerospace recovery and its outlook. After the absolute cratering during the pandemic, this industry has shown remarkable resilience, hasn't it?
It really has. The bounce back has been strong. The International Air Transport Association, IATA, they project that the total number of air travelers globally will reach a record 4.99 billion in 2025. That actually surpasses the pre-pandemic peak of 2019.
Almost 5 billion travelers. So demand is definitely back.
Robust demand is back, yes. And this is translating directly into improved financial health for the airlines themselves. IATA forecasts industry-wide net profits to improve further, reaching around $36 billion in 2025, up from about $32 billion in 2024.
And this positive airline outlook directly benefits Thales' avionics business.
Absolutely, in those two key ways we mentioned. Firstly, it drives demand for new aircraft as airlines expand their fleets to meet this demand and modernize by replacing older, less efficient planes. This boosts Thales' line-fit business, supplying systems for newly built aircraft.
Okay, and the second way?
Secondly, the aftermarket. As more planes fly more hours, there's a greater need for maintenance, repair, and overhaul MRO services. Airlines are also investing in cabin upgrades to improve passenger experience and generate ancillary revenue, things like better Wi-Fi and newer in-flight entertainment systems, which is right in Thales' IFE sweet spot.
And you noted the aftermarket was particularly strong for Thales recently.
Yes, it was a key driver of growth for them in 2023, showing over 30% organic growth in their civil aviation aftermarket activities. And remember, aftermarket services typically carry higher profit margins than original equipment sales, so it's a valuable part of the mix.
Okay, strong recovery.
Yeah.
But one potential headwind we hear a lot about is the ongoing supply chain constraints and production challenges at the big aircraft manufacturers, Boeing and Airbus. Could that limit the upside?
That's a valid concern, and it is impacting the rate of new aircraft deliveries. It's definitely a constraint in the short to medium term.
So fewer new planes getting delivered might dampen the line fit demand.
It could, yes. However, there's a potential silver lining here, or at least a partially offsetting positive effect for companies like Thales.
Oh, how's that?
Well, if airlines can't get enough new planes as quickly as they'd like, it forces them to operate their existing aircraft for longer, and that, in turn, boosts demand for maintenance, repairs, and crucially, upgrades to keep those older planes competitive and efficient.
Ah, so more demand for the higher margin aftermarket services Thales provides.
Exactly. So for you, the listener, the question really becomes, how effectively can Thales navigate this complex dynamic? Balancing the slower than hoped for new aircraft deliveries with potentially increased opportunities in the aftermarket. It requires agility, #tag structural growth in cybersecurity and digital identity.
Okay, tailwind number 3, the structural growth in cybersecurity and digital identity. Thales' DIS segment seems perfectly positioned to ride this wave, especially after integrating Imperva.
Absolutely. These aren't just cyclical trends, these are fundamental long-term shifts in how the world operates. The cybersecurity market itself is just exploding, driven by two main things: the ever-increasing frequency and sophistication of cyber attacks, which are constantly in the headlines.
Seems like every week there's a new major breach.
Pretty much. And secondly, the ongoing digital transformation of, well, everything. Businesses, governments, our personal lives, everything is moving online, creating a vastly larger attack surface that needs protecting.
And the market growth numbers reflect this.
Dramatically. Gartner, a leading tech analyst firm, projects that end-user spending on information security and risk management will surge from around $184 billion in 2024 to nearly $294 billion by 2028.
Wow, that's huge growth. What's the CAGR on that?
That represents a compound annual growth rate, or a CAGR, of about 12.5%. And within that broad market, we're seeing even faster growth in specific subsegments that are highly relevant to Thales' strengths.
Like what?
Things like cloud security, projected at nearly 26% CAGR, managed security services at 15% CAGR, and data security, protecting the data itself, at 14% CAGR. These are all areas where Thales, especially with Gemalto and Imperva's capabilities, has significantly bolstered its position.
Okay, so cybersecurity is booming. What about the digital identity side?
That market is also seeing explosive growth. There's just this immense growing need for secure, reliable, and verifiable digital identities across every aspect of modern life. Forecasts suggest growth rates in the range of 16% to 21% CAGR through the end of the decade for the digital identity market.
What's driving that specifically?
Several things. The massive shift to online services, obviously banking, shopping, government services, remote work. Then there are evolving regulatory requirements globally around data privacy and know your customer (KYC) rules, which demand robust identity verification. And simply the ubiquity of mobile devices, which are increasingly used for authentication and accessing services.
And Thales has strengths here too.
Definitely. A crucial point here is that biometric solutions, fingerprint, facial recognition, etc., are a core strength for Thales, stemming partly from the Gemalto acquisition. And biometrics currently represent the largest and fastest growing segment within this broader digital identity market.
So pulling it back, these digital trends, they aren't just temporary boosts.
Not at all. That's the key takeaway for you. These are not cyclical trends tied to economic booms and busts. They are deep structural shifts driven by the fundamental digitization of the global economy and the recognition that data is a critical asset that needs robust protection and secure access control. This ensures continued strong demand for Thales' trust and security solutions in its DIS segment for the foreseeable future, providing a powerful long-term growth engine for the company that's much less susceptible to broader economic downturns than, say, commercial aerospace might be.
Okay, we've talked about the markets and the tailwinds. Let's shift gears now and talk about Thales' competitive edge. What makes them stand out? They clearly enjoy a pretty robust standing, built on technology, deep customer relationships, and as you mentioned earlier, those high barriers to entry.
Yes, they have several strong competitive advantages, or moats, as they're often called, protecting their business.
So maybe let's start by putting Thales in context. How do they stack up against their main rivals in each key area?
Good idea. So, in defense and aerospace, Thales is undoubtedly a top-tier global player. However, it's generally smaller in overall defense revenue terms than the giant U.S. defense primes.
Hmm.
Lockheed Martin, RTX, formerly Raytheon, Northrop Grumman, and also smaller than its major European rival BAE Systems.
Right. I think the stats showed Thales ranked around 17th globally in defense revenues in 2024.
That sounds about right. But a really key differentiator for Thales, especially compared to the pure-play defense giants, is its more balanced portfolio. As we discussed, defense and security was about 53% of its revenue in 2023. For someone like Lockheed, it's closer to 96%.
So that diversification provides resilience, like we said, but maybe sometimes means it doesn't get the same valuation boost when defense stocks are really flying high.
That can happen, yes. During periods of intense focus on defense, the market might favor the pure plays, potentially giving Thales a bit of a valuation discount despite its strengths. It's a trade-off.
Okay, what about in avionics? Who are the main competitors there?
The avionics market is basically a global oligopoly. It's dominated by a handful of very large players. Besides Thales, the other main ones are Collins Aerospace, which is part of RTX, and Honeywell.
So a very concentrated market.
Extremely. Thales is firmly established as a top 3 global supplier. They have a particularly strong position in Europe, partly thanks to their very close, long-standing relationship with Airbus. Competition in this space is intense, but it's focused heavily on continuous technological innovation, absolute system reliability crucial for flight safety, and securing long-term support and service contracts. It's a demanding game.
Right. And then there's cybersecurity. You described that market as very different, highly fragmented and dynamic.
Completely different landscape, yes.
Uh,
In cyber, Thales finds itself competing against a much wider array of players. On one side, you have the huge, diversified tech firms like Microsoft and Cisco, who leverage their massive enterprise customer base and broad platforms. On the other side, you have highly focused, often rapidly growing pure-play cybersecurity specialists like Palo Alto Networks, CrowdStrike, Zscaler, and many others.
so where does Thales fit into that crowded picture? What's their angle?
Thales' strength in cybersecurity lies more in specific, often quite deep niches, rather than trying to be everything to everyone. Historically, their strengths were in data security, things like encryption, tokenization, key management, and also in identity and access management, IAM, controlling who gets access to what digital resources.
And this is where the Imperva acquisition comes in again.
Precisely. Imperva was a major strategic move because it significantly bolstered Thales' capabilities in adjacent high-growth areas, particularly application security, like protecting websites and APIs, and strengthening their data security offering further. It gave them much greater scale and a more comprehensive platform to compete more effectively against both the large platform vendors and the specialized pure plays. It was about moving up the cybersecurity value chain.
Okay, that makes sense. But underpinning all of this, perhaps the company's most significant competitive advantage, its deepest moat, really comes down to its technological capabilities and its commitment to R&D, doesn't it?
I would absolutely agree with that. Technology is at the core of everything Thales does, and management seems acutely aware of this. They've publicly stated their plan to invest approximately 4 billion euros in R&D over the 5-year period from 2024 to 2028.
$4 billion in R&D. That's a serious commitment, roughly $800 million a year.
It is. And for you, the listener, it raises that important question. Why is this sustained high level of R&D investment so absolutely crucial for Thales?
Well, I assume it's fundamental to maintaining that premium position in their markets.
Exactly. It's their primary competitive advantage. They're focusing this investment on key differentiating technologies, things like artificial intelligence, which they're applying to develop more autonomous systems, improve threat detection, and even optimize air traffic management. Cutting-edge cybersecurity is obviously huge, including research into future threats like those posed by quantum computing, leading to work on post-quantum cryptography.
Future-proofing their security tech.
They have to. Other areas include next-generation connectivity, like secure 5G networks tailored for military use, often called 5G MIL, and advanced in-flight connectivity solutions. And they're also conducting long-term research into quantum technologies themselves, beyond just cryptography, looking at quantum sensors and computing, although that's more horizon scanning for now. This relentless focus on innovation is what ensures they stay ahead of the curve and continuously refresh their product portfolio to meet evolving customer needs. ### formidable barriers to entry, competitive moats.
Beyond the tech itself, Thales' core businesses are also protected by some pretty formidable barriers to entry, these competitive moats you mentioned. What are the main ones?
There are several significant ones that make it very difficult for new competitors to challenge them effectively. Firstly, especially in the defense sector, you have those decades-long customer relationships and the power of incumbency.
Built on trust, security of supply.
Precisely. Trust built over many years with government defense agencies and ministries, deep integration into national defense industrial bases and long-term programs. It's incredibly difficult for a newcomer, even one with an innovative product, to displace an established, trusted supplier like Thales on major programs.
Okay, relationships are key. What else?
Then there are the massive regulatory and certification hurdles. Both the aerospace and defense industries are subject to extremely stringent safety, security, and performance standards mandated by regulators like the FAA, EASA, and national defense authorities.
The paperwork must be immense.
Immense is an understatement. The process to certify new equipment, particularly safety-critical systems like flight controls or weapon systems, can take many years and cost hundreds of millions of dollars. This alone is a massive deterrent for any potential competitor just looking to enter the market.
A huge upfront cost and time commitment.
Absolutely. Furthermore, you have the high R&D and capital intensity required. The sheer scale of investment needed to develop, test, and manufacture next-generation radar systems, complex satellites, or advanced avionics suites creates an enormous capital barrier that few can overcome.
You need deep pockets.
Very deep pockets and patience. Thales also benefits significantly from its large installed base of equipment. They have systems deployed on literally thousands of aircraft, naval vessels, and land platforms around the world.
It generates ongoing revenue.
Yes, a long and lucrative tail of high-margin, recurring aftermarket revenue from maintenance, spares, training, and upgrades for that installed base. That's a predictable revenue stream that new entrants simply don't have access to initially.
Okay, incumbency, regulation, R&D costs, installed base. Any others?
One more worth highlighting is their proven ability to forge and manage strategic partnerships and joint ventures. They have a strong track record here, with successful JVs like Thales Alenia Space with Leonardo and Eurosam, with MBDA for missile systems. This collaborative approach is often essential for bidding on and executing those very large, complex pan-European defense programs that are frequently too big or politically sensitive for a single company or even a single nation to handle alone. This ability to partner effectively further cements their position within the European defense landscape.
Okay, let's turn now to the numbers, the financial performance. Because ultimately, the strategy and market position have to translate into results. And the story here seems to be one of strong, accelerating growth, and maybe most impressively, that exceptional cash generation we touched on earlier.
That's right. The financials really validate the strategic direction and the market tailwinds. #, revenue and order growth trends.
Looking at the top line, Thales has definitely shown a period of strong and accelerating financial performance. Their sales grown steadily, from around $15.9 billion back in 2018 to that $20.6 billion figure in 2024.
And what's particularly encouraging is the acceleration in organic growth recently. It was 7.9% in 2023, and then it picked up further to 8.3% in 2024. Both of those figures actually exceeded their initial guidance and market expectations.
So good momentum. But you emphasized earlier that the order book dynamics are maybe even more compelling as an indicator of future growth.
I think so, yes. It's the clearest window into future revenue. Thales achieved a book-to-bill ratio significantly above 1.0 for 4 consecutive years, running 1.34 in 2022, 1.26 in 2023, and 1.23 in 2024.
Consistently bringing in more orders than they're billing.
Exactly. This sustained momentum, where new orders are consistently outpacing recognized sales, is what has driven that order backlog to the record-breaking $50.6 billion figure by the end of 2024. As we said, this provides unprecedented revenue visibility for the coming years. For you, the listener, this high degree of certainty about future sales is a major positive factor. #, profitability and margin expansion.
Okay, strong top-line growth and visibility. What about profitability? Has that kept pace?
Yes, profitability has also shown consistent improvement. Their adjusted EBIT margin, which is a good measure of underlying operational profitability, has steadily expanded. It went from 10.6% back in 2018 up to 11.8% in 2024.
So nearly 12% adjusted EBIT margin. What's driving that expansion?
It's a combination of factors. Firstly, strong operational leverage as their sales have grown. Their fixed costs are spread over a larger revenue base, so profits grew proportionally significantly faster. Secondly, disciplined cost control across their operations. And thirdly, a generally favorable business mix, with growth often coming from those higher margin activities, particularly in DNS and the aerospace aftermarket.
And this translated to bottom line growth, too.
Yes, their adjusted net income grew by a solid 7% in 2024, reaching $1.9 billion, further demonstrating that positive profitability trend.
But let's come back to what you called the standout feature, that exceptional ability to generate cash. Can you remind us of those numbers?
Sure, they generated free operating cash flow, or FOCF, of over $2 billion for 3 consecutive years, 2022, 2023, and 2024. That's a lot of cash being generated year after year.
Over $2 billion annually. And the conversion ratio.
Ah, yes, the cash conversion ratio. This measures how much of their adjusted net income they actually convert into free operating cash flow. And for Thales, this ratio has been consistently above 100% for 5 straight years. It was 115% in 2023 and 114% in 2024.
Over 100% for 5 years straight. That's genuinely remarkable. Significantly above average, you said.
Significantly above the industry average, yes. It's a real mark of financial quality and top-tier operational execution.
So digging a bit deeper, what specifically allows them to achieve such strong cash flow? What are the mechanics behind it?
Several factors really contribute. A big one, particularly in defense and security, is favorable contract terms. They often receive significant advance payments when a contract is signed and milestone payments as the project progresses. This pulls cash into the business upfront.
So they get paid before or as they incur the costs?
Often, yes, or at least a good portion of it. Then there's the disciplined program management we talked about. Successfully managing these large, complex projects, avoiding major cost overruns and delays, is crucial for keeping cash flow predictable.
Right.
And finally, they have very active working capital management initiatives internally. They even have a program reportedly called CAH, which is focused specifically on optimizing inventories, collecting receivables promptly from customers, and managing payment terms with their own suppliers effectively. It's a continuous focus area.
So it's a combination of contract structure, execution discipline, and active financial management.
Exactly. And this strong, predictable cash flow provides the company with significant financial flexibility. It's the fuel that allows them to fund all their strategic priorities, that heavy R&D investment, the bolt-on acquisitions like Imperva, and providing consistent returns to shareholders, all without putting undue stress on their balance sheet. It's absolutely critical to their long-term health and strategic capacity. Tag capital structure and financial flexibility.
Speaking of the balance sheet, what does their debt situation look like?
Looking at their capital structure, Thales reported a net debt position of $3.0 billion at the end of 2024.
$3 billion net debt. How does that stack up?
Given their scale, their profitability, and especially their robust and consistent cash flow generation, that $3 billion figure appears quite conservative and manageable. It certainly provides them with ample financial flexibility to continue pursuing their strategic agenda, including potentially more targeted bolt-on acquisitions if the right opportunities arise. They're not financially constrained.
Okay, so if someone were looking at, say, a summary financial table for Thales covering the last, 7 years or so, what would be the key trends that jump out?
Well, guiding you, the listener, through that kind of table, what truly stands out is the consistent upward trajectory across almost all the key metrics. You'd see steady, often accelerating growth in order intake, year after year building that backlog. You'd see sales moving consistently upwards, adjusted EBIT and adjusted net income showing clear expansion over the period.
With maybe a dip in 2020?
Yes, you'd likely see a noticeable dip in 2020, reflecting the initial sharp impact of the COVID-19 pandemic, particularly on the aerospace side. But what's equally important is you'd see a rapid recovery in the following years and a resumption of that upward expansionary trend.
And the cash flow.
Crucially, you'd see that the free operating cash flow generation remained remarkably strong throughout most of this period, and that exceptional FOCF conversion ratio stayed consistently high, generally well above 100%, even during the more challenging years. This really underscores the underlying financial strength, the resilience of the business model, and the effectiveness of their cash management strategies. It's a picture of consistent growth underpinned by very strong cash generation. #6. Growth Opportunities and Strategic Initiatives, 2024-2028 Plan.
Okay, so Thales has clearly performed well and is benefiting from strong market wins. But they're not just sitting back and enjoying the ride, are they? They laid out a pretty ambitious strategic roadmap at their Capital Markets Day in November 2024.
That's right. They're not resting on their laurels. They presented a detailed plan for what they call accelerated, profitable, and sustainable growth, looking out towards 2028. It signals a clear intent to push forward and build on the current momentum.
So for you listening, understanding their medium-term financial targets for this 2024-2028 period is really key to assessing their ambitions. What are the headline goals?
They're aiming for organic sales growth averaging between +5% and +7% per year on a compound annual growth rate CAGR basis. That's notably an acceleration compared to their historical growth rates over the previous cycle.
Okay, 5-7% organic growth annually. What about profitability?
They're targeting a significant improvement in their adjusted EBIT margin, aiming for a range of 13% to 14% by the year 2028.
13 to 14%. That's a pretty big step up from the 11.8% in 2024.
It is. It implies a margin expansion of somewhere between 140 and 240 basis points from the 2023 level over the 5-year period. That's ambitious.
And cash flow, are they expecting that stellar performance to continue?
They're guiding for free operating cash flow conversion to average between 95% and 105% of adjusted net income over the 2024-2028 period. So still very strong, maybe normalizing slightly from the exceptional 110% levels seen recently, but still aiming for benchmark performance around the 100% mark on average.
So if they hit these targets, faster sales growth, higher margins, strong cash conversion, what does that imply for earnings?
Well, achieving these targets consistently over the 5 years would translate into very impressive growth in the bottom line. Our analysis suggests it implies something in the region of 50% to 60% growth in their adjusted earnings per share, EPS, over the 5-year plan period. That's the kind of growth profile that gets investors interested. #, segment-specific strategies.
Okay, ambitious group targets. How do they plan to achieve this? How does each of the main business segments contribute? So what's the strategy for defense and security?
For D&S, the strategy is really about leveraging their existing strong market position and expanded production capabilities to fully capture the growth opportunities presented by that global defense upcycle. They're targeting a sales CAGR within D&S of +6% to +7% per year, and aiming to push the segment's EBIT margin towards 13% by 2028.
Okay, capitalizing on the defense boom, what about avionics?
In avionics, the plan is to capitalize on their state-of-the-art product portfolio, both the line-fit systems for new aircraft and their strong aftermarket offering to meet the robust demand coming from the commercial aerospace recovery and ongoing fleet modernization. They're targeting a sales CAGR here of +5% to +7% annually and aiming for an EBIT margin of 13% to 14% by 2028.
13 to 14% margin in avionics. That sounds challenging given the competitive landscape.
It is challenging. Achieving that level in the highly competitive avionics segment will definitely demand what we called flawless execution. It requires sustained pricing power, continued strength in that high-margin aftermarket business, and excellent operational efficiency.
Now let's talk about space. You mentioned this was the area needing a turnaround. What are the targets here?
Space has, let's say, more modest top-line ambitions. They're targeting a sales CAGR of only around +2% per year. However, the critical target here is on the margin side. They are aiming for a very significant recovery in profitability, targeting a 7% plus EBIT margin by 2028, up from much lower levels recently.
Only 2% sales growth, but a big margin jump to over 7%. Why is the space recovery so important?
Well, think about the math. For the overall group to hit that ambitious 13–14% margin target by 2028, getting the space division's profitability back up to a respectable level is mathematically critical. It's currently a drag on the group average, so lifting its performance is essential for the overall plan to work. It's a key focus area for management and arguably one of the bigger execution risks in the plan.
Right, we need to watch that space margin closely.
Yeah.
And how do they plan to actually achieve that turnaround beyond cost control?
It involves that disciplined approach to project selection we mentioned, focusing on bids where they have a strong technological or commercial edge, leveraging their expertise in specific applications like high-resolution Earth observation, secure government communications, and navigation where margins are typically better, and carefully managing their investments and industrial footprint to align with the market reality, particularly the shift towards ELEO constellations, without chasing unprofitable volume. It's about selective engagement and operational excellence.
Okay. And finally, cyber and digital, the DIS segment. What's the plan there?
For DIS, the objective is clear. leverage their unique and significantly expanded product offering, particularly with Imperva now fully integrated, to reinforce their leadership position in the fast-growing cybersecurity and digital identity markets. They're targeting a strong sales CAGR here of +6% to +7% annually.
And the margin target for DIS.
This is where they expect the highest profitability. They're aiming for a sector-leading EBIT margin of 16% to 17% by 2028 for the DIS segment. If achieved, this would make it a major contributor not just to growth, but also to overall group profitability. #tag acquisition strategy and integration.
Their strategy obviously isn't just organic growth. Acquisitions have played a big role, as we've discussed. What's the ongoing approach to M&A?
Their stated strategy continues to be focused on targeted bolt-on acquisitions. They're not typically looking for huge company-transforming deals, but rather acquisitions that enhance specific technological capabilities or strengthen market positions in their core areas.
Like Imperva and Cobham Aerocoms were examples of.
Exactly. Imperva brought crucial application and data security scale in cyber. Cobham Aerocoms added key cockpit communication technologies in avionics. These deals fit the pattern strategically relevant, strengthening the core, high-tech focus.
And once they make these acquisitions, integration becomes key, right?
Absolutely. A key strategic priority for management right now, stowed and over the next couple of years, is the successful integration of these acquired businesses, particularly the large Imperva deal. They need to deliver the expected revenue and cost synergies that are baked into those ambitious medium-term financial targets we just discussed.
So for you, the listener, monitoring how smoothly these integrations proceed, are they hitting synergy targets, are cultures meshing? That will be a really important indicator of management's execution success.
Definitely a key area to watch. #tag investment in innovation and emerging technologies. And underpinning all of this growth, both organic and inorganic, is that continued heavy investment in innovation. As we said, they've committed that substantial $4 billion in R&D between 2024 and 2028.
Right, $800 million a year.
And this investment is specifically directed towards developing what they call differentiating disruptive technologies. We mentioned AI, quantum computing, secure cloud architectures, advanced connectivity like 6G research, alongside 5G BALML development.
It really underscores their belief that technology leadership is their primary competitive advantage, doesn't it?
It absolutely does. They see it as the fundamental key to maintaining their premium positioning, winning contracts, driving margins, and ultimately creating long-term value across all their segments. It's not just a cost center for them. R&D is the engine of future growth. #tag7, capital allocation and shareholder returns.
Okay, so they're investing heavily in R&D and making strategic acquisitions. How does this fit into their overall capital allocation framework? How do they balance investing for growth with returning cash to shareholders?
Thales employs a pretty clear, disciplined, and arguably conservative capital allocation framework. The foundation, as we've stressed, is that strong and predictable free cash flow generation.
Right, the cash flow gives them options.
Exactly. Their framework then prioritizes how that cash is used. The number one priority is reinvestment back into the business to drive organic growth.
Which means R&D first and foremost.
R&D is explicitly their top priority for capital allocation. That planned $800 million annually is considered essential, non-negotiable spending to maintain technological leadership and feed the product pipeline.
Okay, R&D is priority one. What comes next?
Next comes capital expenditures, or CapEx. This is investment in property, plant, and equipment. Things like upgrading manufacturing facilities, expanding production capacity, particularly to meet that huge defense and security backlog, and investing in digital infrastructure. This is crucial for delivering on their commitments.
Makes sense. Then shareholder returns. How do dividends fit in?
Dividends are a clear and consistent part of the framework. Thales has an explicit policy targeting a payout ratio of 40% of its adjusted net income per share.
40% payout. That seems sustainable.
Yes, it's generally seen as a sustainable level. It allows them to provide a meaningful and growing dividend to shareholders while still retaining 60% of their earnings for reinvestment in the business, R&D, CapEx, and for potential acquisitions or debt reduction.
And has the dividend been growing?
Yes, reflecting the growth in earnings and the consistent policy, the dividend per share has been steadily increasing. For example, it was 2.94 for 2022, rose to 3.40 euro for 2023, and the proposal proposal for 2024 was 3.70 per share. It demonstrates a commitment to returning value progressively.
Okay, so R&D, CapEx, dividends. What about share buybacks? A lot of companies use those heavily, especially in the U.S.
This is where Thales differs significantly from many of its peers. Their share buyback programs are described as primarily functional.
Functional, what does that mean?
It means the buybacks are mainly designed to acquire the necessary treasury shares needed to service their employee share ownership plans. Many Thales employees receive shares as part of their compensation or have options to buy shares. The company buys back shares in the market to fulfill these obligations, effectively offsetting the dilution that would otherwise occur from issuing new shares to employees.
So they're not really using buybacks as a primary tool to actively reduce the total share count and artificially boost earnings per share, EPS.
Generally, no, it's not their main purpose. This reflects what you might call a more conservative stance or perhaps a European corporate governance norm. They tend to prioritize strategic reinvestment in the business through R&D, CapEx, and M&A over using cash for financial engineering via large-scale buybacks aimed purely at EPS accretion. It's a different philosophy.
Interesting distinction. So summing up capital allocation. R&D first, then CapEx to support growth and delivery, then a sustainable dividend, and buybacks mostly just to cover employee share plans.
That's a good summary of their stated priorities and actions. It's a framework built on organic growth investment, supported by strong cash flow. #hashflow, recent developments and challenges, 2022-2024.
Okay, let's look back at the recent past, say the period from 2022 to 2024. This has clearly been a pretty transformative time for Thales, marked by those big strategic portfolio changes and really strong commercial momentum, but all happening against a backdrop of, well, a pretty complex global economic environment.
Absolutely. A lot has happened in a relatively short period. #, supply chain disruptions and inflationary pressures.
One challenge that hit almost every industrial company during this time was supply chain disruptions and inflationary pressures. How did Thales navigate that? You mentioned it particularly impacted the space segment.
Yes, like pretty much everyone in the manufacturing and technology sectors, Thales definitely contended with supply chain bottlenecks, component shortages, and rising input costs. These challenges were felt most acutely, as publicly acknowledged, in the space segment, where specific supply difficulties were cited as a key reason for project execution delays back in 2023.
Are those supply chain issues still a major active constraint for them now, or have things largely eased?
The situation has generally been improving across most industries, including aerospace and defense, compared to the peak disruption periods of 2021-2022. However, vigilance is definitely still needed, especially for highly specialized electronic components or materials where supply chains remain tight or geographically concentrated.
But Thales managed to protect its margins during this inflationary period.
Yes. A key strength for Thales during this time, and a testament to their management and market position, has been their ability to largely pass on rising input costs to customers through price escalation clauses often built into their long-term contracts, particularly in defense. They also focused intensely on driving internal operational efficiencies to offset cost pressures.
So proactive management was key.
Absolutely. It was crucial for protecting and even expanding their profit margins in that challenging inflationary environment. So while things might not be entirely back to normal pre-pandemic stability, their proactive management has been a significant factor in their financial resilience. #, major contract wins and backlog growth.
While navigating those challenges, this period was also characterized by really outstanding commercial success, wasn't it? Driving that order book to record levels.
Without doubt. Their commercial teams have been firing on all cylinders. They secure a very steady and impressive stream of large contracts, which Thales typically defines as orders valued over $100 million.
Can you give some examples?
Sure. In 2022, they booked 29 of these large orders, including that massive multi-billion-euro contract for the Rafale fighter jets for the United Arab Emirates, where Thales provides the radar, electronic warfare suite, and other key systems.
Okay, a huge win. Did the momentum continue?
It did. In 2023, they signed another 25 large orders. Notable examples included the contract for the Italian IRIDE Earth observation satellite constellation and a major upgrade program for French and Italian Horizon-class naval frigates.
And 2024.
The strong run continued into 2024, where they booked an impressive 35 large orders. This included securing more Rafale aircraft orders, this time for Indonesia. Also, contracts for advanced sonar systems for France's next-generation nuclear submarines and major orders for air defense missile systems like the MPT-NG for France and Italy through the Eurosam JV.
So a consistent flow of high-value wins across different parts of the DNS portfolio.
Exactly. These big flagship contract wins are clearly the primary engine driving that record $50.6 billion backlog we keep mentioning. It's tangible proof of their strong market position and the demand for their technology underpinning their future revenue stream. #, strategic portfolio reshaping.
And alongside this commercial success, a defining feature of this 2022-2024 period was that deliberate and significant transformation of their business portfolio.
Yes, some major moves reshaped the company. We saw the completion of the divestment of their ground transportation systems business to Hitachi Rail. As we discussed, this marked a strategic exit from a large but lower margin, more capital-intensive area, allowing them to sharpen their focus.
Right, shedding non-core assets. And then the flip side was the acquisitions.
Correct. Conversely, they made those two very significant strategic acquisitions. Imperva in cybersecurity, dramatically scaling up their presence in application and data security, and Cobham Aerocoms, enhancing their capabilities in critical cockpit communication systems within the avionics segment.
So it was a clear and decisive pivot towards higher growth, higher margin, strategic technology areas that align better with their core competencies: defense, aerospace tech, and digital security.
Precisely. A very deliberate reshaping to position the company for the future. #, balance sheet de-risking.
One other notable development during this period, perhaps less headline-grabbing but strategically important, was related to their pension liabilities.
Yes, that's right. In 2023, Thales took a significant step to de-risk its balance sheet regarding its UK pension obligations. They completed a buy-in transaction, transferring the liabilities of their main Thales UK pension scheme to a specialist third-party insurer, Rothesay Life.
What was the impact of that?
Well, executing this transfer involved a substantial one-time accounting charge and cash contribution. The expense was around $349 million. However, the strategic benefit was significant. It effectively removed a large, complex, and potentially volatile long-term financial liability from the company's balance sheet.
So it reduced future risk and uncertainty.
Exactly. Pension liabilities can fluctuate significantly based on things like interest rates, inflation, and how long pensioners live. By transferring this risk to an insurer, Thales improved its future financial predictability and stability, even though it came at a considerable upfront cost. It removed a significant potential overhang. #9, key risk factors.
Okay, we've painted a pretty positive picture. Overall, strong markets, good strategy, solid execution. But no company is without risks. Despite its strengths, Thales is certainly exposed to a range inherent to the industries it operates in. It's important for you, the listener, to be aware of these factors.
Absolutely. Understanding the potential downsides and challenges is crucial for a balanced perspective. #, government budget, and defense priorities.
Let's start with the most obvious one, perhaps, their heavy reliance on government spending, especially in defense and security.
That's right. A very significant portion of Thales' revenue, particularly in DNS, depends heavily on the national budgets of a relatively small number of key government customers. France being the largest, but also the UK, Australia, the US to some extent, and key export customers in the Middle East and Asia.
And while defense spending is in a strong upcycle right now, that can change, can't it?
It absolutely can. Government budgets are always subject to political shifts, changing economic conditions, and competing priorities. Future periods of fiscal consolidation, shifts in political alignment, or changes in stated defense priorities could lead to program delays, scope reductions, or outright cancellations.
Which would directly hit Thales' revenue and order intake.
Directly and potentially significantly, given the size and importance of the DNS segment, it's an inherent dependency. #, program execution and contractual risks.
Another major risk area must be the execution of those huge, complex programs they undertake.
Yes, this is a constant challenge in this industry. Thales is involved in developing and producing some of the most technologically complex systems in the world, often under long-duration contracts with demanding performance requirements and fixed price elements.
So what can go wrong?
Many things. Unforeseen technical challenges can emerge during development. Supply chain disruptions can cause delays or component failures. Managing vast networks of subcontractors is complex. Cost overruns can occur if initial estimates were too optimistic or problems arise. Schedule delays can push out revenue and impact profitability.
And the consequences of failure can be severe.
They can be. Failure to meet key contractual performance milestones on a major program can trigger significant financial penalties. It can also cause serious reputational damage with key customers. And as we saw acknowledged in their space business recently, execution issues can directly impact segment profitability. Flawless program execution is critical, but it's never guaranteed on these complex endeavors. Tag geopolitical and export control risks.
Thales operates globally, which
Yeah.
brings opportunities but also geopolitical risks, right?
Definitely. Operating as a major global defense contractor inherently exposes Thales to the shifting sands of international relations. Sudden changes in geopolitical alignments, the imposition of sanctions or embargoes on certain countries, or shifts in alliances can directly impact their ability to access markets, collaborate with international partners, or source components.
And exporting defense technology must be tightly controlled.
Extremely tightly controlled. The export of sensitive defense and dual-use technologies is subject to stringent and constantly evolving national and international regulations and controls, like ITAR in the US or equivalent rules in Europe. Navigating these complex export control regimes adds layers of complexity and risk to their international business activities. A misstep here can have serious legal and reputational consequences. #tag technology obsolescence and innovation risks.
We talked about technology being their core strength, but that's also a risk, isn't it? The risk of falling behind.
It absolutely is. Thales' competitive advantage is fundamentally built on its technological leadership. But the markets they serve, defense, aerospace, cybersecurity, are characterized by incredibly rapid technological change and intense innovation cycles.
So they have to keep running just to stay in place.
Pretty much. A critical question for them is, can they consistently invest enough in R&D and invest it wisely to keep pace with advancements in critical areas like AI, cybersecurity threats, quantum technologies, advanced materials, and new communication standards?
And if they fail to innovate effectively.
Failure to innovate, or even just a significant misjudgment of future technological trends or competitor moves, could lead to their products becoming obsolete or less competitive. This could erode their market share, pressure their margins, and damage their premium brand perception. Continuous, successful innovation is not just a goal, it's a necessity for survival at the top. #tag currency exposure.
What about financial risks? Currency fluctuations must be a factor for a global company like Thales.
Yes, currency exposure is a significant factor they have to manage. As a truly global company, they generate sales in a wide variety of currencies: US dollars, British pounds, Australian dollars, various others. However, a large portion of their cost base, particularly R&D and manufacturing in France and Europe, is denominated in euros.
So if the euro strengthens,
A significant appreciation of the euro against key currencies like the US dollar can have a negative translation effect when they convert those foreign currency sales back into euros for reporting purposes. This can make their reported revenue and profit growth look weaker. Perhaps more importantly, a stronger euro can also impact the price competitiveness of their products in international markets when bidding against competitors based in, say, the US or UK.
do they hedge against this?
Yes, like most large multinationals, Thales engages in hedging strategies using financial instruments to mitigate some of this currency risk, particularly short-term transaction exposure. However, hedging cannot eliminate the risk entirely, especially longer-term translation risk or impacts on competitiveness. It's a constant financial management challenge. #tag customer and program concentration.
One final risk area while they are diversified. Is there a risk of being too reliant on a few key customers or programs?
That's a valid point. While Thales has a broad portfolio across segments and geographies, its results can still be significantly influenced by its relationship with and the volume of business from a few key anchor customers. Think the French DGA, the Defense Procurement Agency, major partners like Airbus, and large national defense forces in key countries.
And specific programs, too, like the Rafale.
Exactly. Flagship programs like the Rafale fighter jet, major satellite constellations, or large naval programs can represent a substantial portion of revenue and profit for certain periods. Any significant disruption in the relationship with a major customer or a major technical or commercial issue arising on one of these cornerstone programs could potentially have a disproportionate negative impact on the company's overall financial results and market perception. It's a concentration risk that comes with playing at the top end of these markets.
Okay, let's tackle the big question, the one many listeners might be thinking about: valuation. We've established Thales is performing strongly, has great visibility, and is well-positioned. But the market seems to know this, right? The stock has been priced at what looks like a significant premium.
That's fair to say. The market has certainly recognized the positive story, and Thales' shares have reflected that, trading at multiples that are generally above historical averages and often above direct peers.
So for you, the listener, the critical question becomes, is this premium valuation truly justified by the fundamentals and the outlook, or has the market gotten ahead of itself?
Exactly. It's the core investment question right now. To get some critical context, we can compare Thales' valuation multiples against its peer group companies like RTX, BAE Systems, Lockheed Martin, maybe even Safran or Honeywell in certain aspects.
How does it look on, say, a price-to-earnings PE basis?
Well, if you look at a simple trailing PE ratio, based on past earnings, Thales' multiple, which was cited as 45.5x in some analyses, appears significantly more expensive than the peer average, which might be closer to 30x. However, it's really important to be cautious with trailing PE ratios.
What is that?
Because past earnings can often be distorted by non-recurring items, large one-off expenses like that UK pension transfer charge we discussed, or significant accounting adjustments. These can make the trailing PE look artificially high or low and not reflect the underlying earnings power.
Okay, so trailing PE might be misleading. What about forward PE based on analysts' earnings forecasts?
That's generally considered a more relevant metric for valuation. On a forward PE basis, one analysis put Thales at around 20.6x estimated earnings. This is still at a noticeable premium compared to the peer group average, which was estimated around 18.0x.
So still more expensive than average, even looking forward. How about other metrics like enterprise value, EV-based multiples?
Similar story there. Looking at metrics like EV to sales or EV to EBITDA, Thales generally trades at a slight premium compared to the industry average for large-cap aerospace and defense companies. So across the board, the market is clearly assigning a higher valuation to Thales relative to many of its competitors. #, justification for valuation premium.
Okay, the premium exists. Now, the crucial part. Why might the market be willing to pay more for Thales? What are the fundamental arguments justifying this higher valuation?
There are several strong arguments that analysts and investors point to. Firstly, there's the superior growth profile, particularly on the top line. Management's guidance for 5-7% organic sales CAGR over the next 5 years is genuinely at the higher end for a large-cap defense and aerospace company. Plus, that significant exposure to the even faster-growing cybersecurity market via the DIS segment provides an additional growth kicker that many pure-play defense peers lack.
So faster growth potential commands a higher multiple. Makes sense. What else?
Secondly, there's that unmatched revenue visibility provided by their record $51 billion order backlog. Having roughly 2.5 years of sales already secured provides a rare and highly valued degree of predictability, especially in today's uncertain economic climate. Markets pay a premium for certainty.
Predictability is valuable. What about the cash flow?
That's number 3, and it's huge. Thales' consistent ability to generate free cash flow at a rate exceeding 100% of its net income is a clear mark of high financial quality and exceptional operational efficiency. Strong, reliable cash generation is highly prized by investors and absolutely justifies a premium valuation compared to companies with weaker or more volatile cash flows.
Okay, growth, visibility, cash flow quality. Anything else?
Finally, there's the strategic positioning itself. Thales seems perfectly aligned with that powerful trinity of secular tailwinds we discussed: the defense modernization supercycle, the robust aerospace recovery, and the relentless structural growth in digitalization and cybersecurity. Being strongly positioned to benefit from all 3 of these major global trends simultaneously is a compelling narrative that supports a premium valuation.
It's like they're positioned at the confluence of several major rivers of growth.
That's a good analogy. And one other valuation perspective worth considering, given the diverse nature of Thales' business, is a sum of the parts (SOTP) view.
Valuing each segment individually.
Exactly. If you were to value each segment, DNS, avionics, space, and DIS, separately, based on the multiples typically applied to comparable pure-play companies in those specific sectors, what would you find?
Well, I'd imagine the digital identity and security DIS segment, being more software-centric and focused on high-growth cybersecurity, would likely command a significantly higher valuation multiple as a standalone entity, right? Similar to pure-play cyber stocks.
Precisely. DIS would almost certainly be valued at a much higher multiple than the more traditional defense or even aerospace segments. Therefore, the argument goes, as DIS continues to grow strongly and becomes an increasingly larger proportion of Thales' overall revenue and profit mix, this should naturally help to lift the valuation of the entire group over the long term.
So the increasing weight of this high multiple disk segment could drive further value creation over the long term as the market better recognizes its distinct growth profile within the larger Thales structure. It might help narrow any perceived conglomerate discount.
That's certainly the investment thesis many proponents would argue. The SOTP perspective highlights potential hidden value within the diversified structure, particularly driven by the high growth, high margin potential of the disk business. Hashtag tag 11, key metrics to monitor.
Okay, so we understand the strategy, the performance, the risks, and the valuation debate. For you, the listener, who might want to follow Thales going forward, what are the key metrics you should really keep a close eye on to assess their ongoing performance and whether they're delivering on that ambitious 2028 plan?
That's a great practical question. There are several key performance indicators, KPIs, that offer good insights into the company's health and trajectory.
What's top of the list?
I'd start with the book-to-bill ratios, broken down by segment if possible, but definitely the group level. This remains the primary leading indicator for future revenue growth. You want to see this ratio sustained comfortably above 1.0, especially in the large defense and security segment, to confirm that demand remains robust and the order backlog continues to be replenished or grow. A sustained drop below 1.0 would be a warning sign.
Okay, book to bill first. What's next?
Look beyond just the total value of the order backlog and consider its quality and duration. Is the composition changing? Are they winning more long-term service contracts, which tend to be higher margin and more predictable? What's the average duration of the backlog? A high-quality, long-duration backlog provides enhanced predictability.
Got it. What about profitability?
Absolutely critical to track the margin expansion or contraction drivers. Monitor the adjusted EBIT margins by segment. Pay particular attention to that planned recovery in the space division. Are they making progress towards that 7% plus target? And is the DIS segment delivering on its path towards that 16-17% margin goal? These segment-level trends are key to hitting the overall group margin target. Any significant deviation here needs explanation.
And the all-important cash flow.
Yes, keep a very close eye on the free cash flow conversion rates. Are they continuing to perform within or ideally above that 95-105% target range set out in their plan? Any significant or sustained drop below this level could signal underlying issues with working capital management, program execution, or contract terms, raising questions about their operational efficiency and the quality of earnings.
Makes sense. What about innovation? How do we track that?
That's harder to quantify precisely, but watch for indicators of R&D efficiency and innovation pipeline health. Are they launching successful new products that win market share? Are they winning contracts specifically based on newly developed technologies? Are they maintaining a strong patent portfolio? While R&D spending is one thing, the output and market success resulting from that spending is what ultimately matters for sustaining technological leadership.
Okay. Anything else we should monitor?
One final area is international revenue diversification. Keep track of the geographic mix of both order intake and sales. Is the strong growth momentum in emerging markets, particularly the Middle East and Asia, continuing? Success here validates their international expansion strategy and provides crucial diversification away from potential slowdowns in their traditional European home markets. It shows if the dual-engine growth model is firing effectively. Hashtag outro.
Wow. Okay, that was certainly a deep dive into Thales SA. We've really covered a lot of ground today. We journeyed through their strategic repositioning, unpacked those three powerful yet very distinct business segments, explored the massive global tailwinds pushing them forward, examined their competitive strengths and moats, and analyzed their pretty impressive financial performance and future targets.
We did, and I think what emerges is a picture of a company that's not just large and complex, but strategically positioned right at the intersection of some of the most critical and dynamic trends shaping our world today: defense, aerospace, and digital transformation.
It really feels like they embody this fascinating balancing act, doesn't it?
It really does. They're constantly navigating the inherent complexity, balancing those long-cycle, high-stakes government contracts in defense with the faster-paced, shorter-cycle digital services in DIS. Balancing the stability of mature markets with the dynamism of high-growth emerging regions, and balancing their foundational, hardware-centric defense business with the innovative, software-driven world of digital identity and cybersecurity.
And that dual-use technology concept seems key to holding it all together.
I believe it is. That continuous investment in developing core technologies that can be leveraged across both military and civil applications, that's what underpins this unique blend. It provides resilience, fosters innovation, and allows them to adapt effectively in a rapidly changing and often converging technological landscape.
That's a really powerful point to end on. So let me leave you, our listener, with a final provocative thought to mull over. Considering the profound and accelerating impact of both evolving geopolitical tensions on one hand and the relentless pace of digitalization on the other, how might Thales' dual-use technology strategy, this ability to serve both military and civil needs, often with the very same underlying tech unio, how might that shape not just Thales' own future, but perhaps the broader technological landscape itself, in a world increasingly defined by both conflict and connectivity?
It's a fascinating question to ponder, isn't it? I encourage you to think about the implications. What does it mean for innovation, for security, for society, when a single company becomes a key enabler in such disparate yet deeply interconnected global forces? When the same core technology might be protecting a nation's critical infrastructure one moment and securing your online banking transaction the next. It really raises some important strategic questions about the future direction of technology in the 21st century.